that extracts from the statement of financial position of Network are as follows. Balance sheet at 30th September 2002 and 2001. Ordinary shares 500 million to 750 million. So it looks like that some new share capital has been issued. Share premium also has been collected. On 1st October 2001, a bonus issue of new shares for every 10 held was made. So 1st October 2001, actually you gave some bonus issue. Finance from the share premium account. So whenever you make a bonus issue, so in bonus issue, what happens that the share you do not receive any cash. It is just like debit share premium account, credit share capital account. So money is transferred from premium to capital. So cash is not involved in bonus issue. What amount will appear under the cash flow from financing activities in the statement of cash flows for the year ended 30th September 2002? So if you see that, what I can see here, that you've got 2002 and you have 2001 and you have here, capital and you have here premium. So it is 750 and it is 350, it is 500, it is 100. And if you pay attention here, so the difference is here 500, okay? The difference is here. So you have here 1100 in total and you have 600 here. So how much is the cash received? Yes, can you speak? Can you tell how much cash you are receiving? Ankit? Hello?
Yes, sir.
Cash received. Can you make a comment here, Pamela?
1.1.
Sorry? Okay, cash received, let me tell you, the difference of these two, 1100 minus 600, cash received will be 1100 minus 600 is equal to 500. So your answer is actually 500 million. But how do you do that? How do you understand it? This is, I told you the answer. Now the thing is that you need to understand. Please pay attention. Whenever you do some bonus issues, your total equity does not change. Usually your total equity, the total of share capital and share premium does not change. I need to explain you in more detail here. Please pay attention. Let me create some example. I want to explain it in such a way you would understand them. Let's suppose that we say that issued, Pamela, you were there in the lesson in the previous, I'm doing the same thing. That was F3, but the question is quite similar. Issued 1 million shares at $1. So it means that cash received is $1 million, right?
Yes.
So you will say debit cash, credit share capital. And it is like, I don't know, 1 million here, 1 million here. Then you said that issued 1 million shares, face value is 1 million shares for $4. So it means that you are issuing shares at a premium because face value is $1, but you are selling it for $4. So $3 is premium. So you say debit cash, which is 4 million, and you would say credit share capital, which is 1 million, because share capital, you only take the face value amount. Any amount which is collected extra, it goes to the share premium account. Now, after these two transactions, you will have here, share capital and you will have share premium. So let's suppose that after these two transactions, your share capital is how much? Your share capital is
1 million.
1 million from here and 1 million from here. And your share premium is this much. And your total equity is 5 million, right?
Right.
Now you say that issued 1 million bonus shares. And of course, bonus shares, whenever you issue bonus shares at always face value. So you will say credit share capital 1 million. So I will credit share capital 1 million. What do I do debit? This time I'm not getting any cash. Previously you said credit cash because you got cash. You said credit, debit cash because you were receiving cash. Now you are giving bonus shares. So bonus shares are not given for cash. So you always say debit share premium account. So when I say debit share premium, so actually I'm decreasing share premium. Before we said credit share premium. When you say credit share premium means that you are increasing share premium. Now you say debit share premium. So what is happening? Effectively, I'm taking out money from share premium and transferring it to share capital. So it is called capitalizing the premium. I'm capitalizing the premium. I'm giving shareholders some additional shares and I'm not getting cash from them. On their behalf, I'm taking money from premium. So when you issue these shares, what is happening? Your share capital will increase. So share capital now is 3 million and share premium will decrease. Share premium will become 2 million. So you add 1 million here and you subtract 1 million here and this is your total. Now, so it means that what I just wanted to show you. So let me call it as a before bonus and I say after bonus. Okay, clear? So bonus issues, your total equity remains same. There is no difference on total equity. It was 5 million before and it is 5 million after. There is just a difference in the account like share capital and share premium will go more or less. Am I clear here until now?
Yes, sir.
Okay, good. Now in this particular question, what they are telling us, they told you that your equity is increasing. The total is increasing from 600 to 1100. So do you think that if it had been all because of bonus, it should not have changed? So they gave some bonus. Because of bonus, there was no change. So any change which is there, that is because of cash. What you receive cash. Because they do not say that during the year you only issue bonus shares. Maybe there are some other transactions also. Like if it had been only the bonus issue transaction, then this amount would not have been increased or decreased. One would increase, one would decrease. From here, maybe I transfer from premium to capital. So premium goes down, capital goes up. But you see that both amounts are increasing. Both amounts are increasing. And any difference between the equity is the cash amount. Understand the point? In bonus share, how do you do? In bonus share, if you pay attention, you decrease the premium and increase the capital. One is decreasing, and therefore the total remains same. But here, premium is also increasing, which means we offered some right issues, and capital is also increasing. So whatever is the increase, like from here to here, bonus issue, they keep both before and after amounts equal. If it had been only bonus issue, then 2001, 2002 total equity would have been same. So difference in equity is actually the cash financing cash. So answer is 500 million. What do you understand?
Sir. Hello?
Yeah, is it clear?
Yes, sir, clear. So there was a line which is mentioned. This was followed by further issue for cash.
Yeah.
So okay. So I think like the upper statement which says that bonus issue of a new share then was held finance from the share premium account. This line actually, if it was not there, doesn't make any sense. Like the answer will be 500 million only.
Yeah. We know that.
It's just to confuse the students.
Yeah, they just are confusing you. We already know that it is not the impact of bonus, because if there had been only bonus issue, the total would have been same. Bonus issue, the total cannot change. The change in the total of equity is actually due to a transaction other than bonus. Bonus issue would not have made this change. If they had only one transaction during the year, let's suppose they only issued bonus shares, let's suppose, then 2001, 2002, the sum total of capital and premium would be the equal amount. One would have gone up, one would have gone down, and they would have remained same if it had been only the bonus issue. So I know that the total is changing because premium is also increasing. In case of bonus, premium never increases, premium decreases. So I'm collecting some premium, which means there are some other transactions. And it is also given here that this was followed by a further issue for cash. Okay?
Yes, sir.
Let's do next one, 275.
So these are examination questions?
Yeah, these are past exam, your BBB kit questions. 275, let's read it, please.
The statement of financial position of Windows at 31st March shows property, plant, and equipment with a carrying amount of 1860. It had increased to 2880. During the year 31st March, plant carrying amount of 240 was sold, and 90,000 depreciation of 280 was charged, and 100,000 was added to evaluation surplus in respect of property, plant, and equipment. What amount should appear under investment activity in the statement of cash flow for the year ended 31st March 2008 as cash paid to acquire property, plant, and equipment?
Okay, so this type of question, you should always be doing with a very simple logic in your mind, what you had. So your opening assets, for how much? It was 1860 million, right? And like I told you in previous class, that always keep 3 zeros in your mind, that you have 3 zeros on the top. So you will say it's 1.860 million, 1.86 billion, so 1860. Now from these assets, they did not remain with you. What happened? That some of the assets you sold, right?
Mm-hmm.
So those assets, they went away from you, sold assets, or you call them disposed assets. So how much value of assets did you sell? You should subtract it.
240.
Huh?
240.
So 240 assets, they left with you. They are no more in your business. Then you are also doing depreciation. How much is the depreciation which you are charging? 280. This is the value which has been reduced by depreciation. And then there is some revaluation also. So how much revaluation you did? 100. So it means that your financial statements, keeping these things in mind, your assets should be like this. Based on your numbers, should be 1440. Agreed with me?
Yes, sir.
But actually, how much do you see on the financial statement?
0.
So it means that purchased or added, I can call it. So the difference is what you purchased or what you added. 1440. Very simple question. Agreed?
Yeah.
You started with what you have in your hand, what you had in your hand. Then some of the assets you sold, some of the assets you depreciated. Then you did revaluation. Considering all these things, your assets in the balance sheet should have been 1440, 1.44 million. But actually you see them at 2.88 million. So where is the difference coming in? The difference is what you added, what you purchased, 144 million.
Sir, suppose the asset is increased to 2700 instead of 2880.
Sorry?
2700. No, this actual
2700.
Yeah.
Then 126 you purchased.
Okay.
And probably your actual balance sheet is 1440. So you didn't purchase anything.
So he's asking what amount should appear under cash from investing activities.
Yes. How much did you purchase? How much did you acquire? This is what we did. So this is your, cash outflow from investing activities, because you are purchasing assets. Purchasing assets means that you are paying out cash for that.
So how about the loss of 90,000?
Which one?
Loss.
Loss is like gain or loss is not related here. That will decrease your profit, but it does not impact your cash. In cash flow, we only talk about cash. Let me ask you, for example, you purchase something for $100 and you sold that thing for $90, right? So do you make profit or loss? Of course, you make a loss. How much? $10 you are making a loss. So if I ask you how much is your cash flow, what do you say? 90. Cash flow is 90. You will say, I received $90. Loss is not spoken here because I'm not asking you how much is your profit. If I ask you profit loss, you will say -10. I'm asking you how much cash did you get. So cash did you get is $90.
I think loss should appear for I think it's operating activities.
Yeah, that goes to operating activities. There is one question which what I'm asking. Okay, let me rephrase Pamela's question. She asked a nice question, but probably she did not ask it as she should ask. So if I know what is going in her brain and what she said. So what she asked me probably is not the appropriate question. Let me rephrase Pamela's question for her. She should ask me that, sir, it says that during the year to 31st March, plant with a carrying amount of 240, the balance sheet amount of 240 was sold at a loss of $90,000, which means that you actually are getting cash 240,000 minus 90,000, right?
Mm-hmm.
This is what you should be saying, that the cash which we are receiving is less. We are actually receiving only 150,000 for that. So what impact we should be doing it here? So why are we subtracting here, how to say, whatever, I don't know, 240. We should be doing 150. No, you should not be doing 150 because I am not preparing it based on cash inflow and outflow. I'm taking it from the net book value. If you pay attention, this 1860, I'm talking about 1860 was the carrying amount. So you start with the carrying amount thing. You were given a carrying amount. So from carrying amount, you subtract the carrying amount. The carrying amount was 240. We are starting with the net book value and we subtract the net book value. And we said that the net book value of the asset is this. And then the net book value at the end is this. And this is the difference.
Okay, understood.
Otherwise, we should also not be talking about depreciation because depreciation is also non-cash thing. Why? You can ask me, sir, we are doing cash flow question. Why are you incorporating depreciation into it? Depreciation is a non-cash item. Why do we do that? This is also a question. Yes or no? Or did I confuse you people? I think I have successfully confused you guys.
No, sir, we understand that is there just for the net book value.
Yeah, there are two ways. Let me explain it because she had a valid point. There are two ways of doing it. One way is that I say that, purchased equipment, or I say sold equipment. And I will say that, I purchased equipment for, I don't know, 200,000. I sold equipment for 60,000. And this is my cash flow from investing activities. This is one way of doing it. That I say, what is the value of equipment I purchased and what is the value of equipment I sold? And I said that I paid 200,000 for buying equipment. I received 60,000 from selling the equipment. So my cash outflow is 140,000. So this actually should be minus 200,000. This is 60,000. So 140,000 is cash outflow. This is one way of doing it. But we have not been given data to do a question like this. They did not tell us how much we purchased. So we are forced to take the book values, the closing book values. One way of doing it is this. If they give us the data, they don't give us the data. So we said that our opening balance is how much? So opening balance of asset was this. Then we depreciated them. We said our book value should have been this much. And if the book value is 1440, but actual value is more, the difference is what we increased. And if we increased, that is investing. So we actually concluded the result in the indirect form because we were not given the complete data. This is what we had to find out. Okay. Clear? Ankit?
Yes, sir. Sorry, I was on mute.
No problem. Let's do 276, please. Let me delete this one. So it's pretty much same. You will start the same way that opening net book value was 14.4 million, right? And then you sold some assets. So it said that, okay, it says depreciation first. So we said that this is our opening asset value. We made some depreciation of 22.5 million. So we subtract that. This much my asset should be decreased. Then there are some disposals. And it says that an item of plant with a carrying amount of 3 million was sold for 1.8 million. Because you are starting with the carrying value, you are starting with the net book value. So you should be talking about net book value. So out of this 14 million, 3 million of asset is no more with us. It is gone. So I decreased it. A property was revalued upward by 2 million. So some of the property was revalued. So there was a revaluation of 2 million. I added 2 million on the top. And then the last one, okay, until here, it is the same like last question. There is nothing different. Environmental provisions of 4 million relating to property, plant, equipment were capitalized. So you capitalized some provision. So when you capitalizing, you are doing capitalization, your assets are increasing. Capitalized means that converting it into asset. So 4 million, I made additional asset. So according to these adjustments, your closing assets should have been like this much. Should have been 14.9 million. But actually, what you have is 23.4 million. So the difference is addition. It means that this much of asset you added into the system, which is 8.5 million. This is your addition, and this is called your investing outflow. It's very simple, except for this thing you need to understand. Only this one provision. Is it clear?
Creating provision.
Yeah, capitalize the provision. You had a provision and you capitalized it. Like you remember, you capitalized your when you purchase a tangible asset for renovation, restoration. There is some provision you added into the cost of tangible or intangible asset. Yes or no?
Yes, sir. We use discounted.
Yeah. So the present value of that provision you added into the asset.
Yeah.
So we are adding the value to the asset. It is plus.
Okay.
Yes, Mala.
Yes, it's fine, sir.
Okay. 277. Again, looks simple. The carrying amount of property, plant, equipment was 410 million at 31st March and 680 million at 31st March 2002. During the year, property with a carrying amount of 210 million was revalued to 290 million. So there was a revaluation of 80 million you should take. Okay. Depreciation charge was 150 million. There was no disposals. That's very simple. Pretty much easy. So where are you starting from? 410. 410 and then
add valuation 80
plus 80 minus 115. So this is what it should be. So I put it here. It should be 375, right? And actual is 680. And additions are this minus this 305. Very simple. Done and dusted. Then do 278. Payments made under leases you have to calculate. So non-current assets, property, plant, equipment, right of use 2.5, 6.5. Non-current liabilities, lease obligations 2, 4.8. Current liability lease obligation is also increasing. During the year to 31st March, depreciation charge on lease equipment is 1.8 million. What amount will be shown in the cash flows for respect of payments made under leases? Payment made under leases. So how much is your opening balance of lease?
2,000 plus 800.
So if you pay attention, you had how much did you say?
2,000 plus 800 because it doesn't split with split to current and non-current.
Opening lease liability was 2,800. And how much did you make payments? And how much is your, so this is your this year and lease liability, and you had lease assets here, 2,500, and you had this 2,500 also. And how much you are adding? So adding during the year. So if you pay attention that it has gone up by 4,500, you know, your leased assets are increasing. So it means that you added 4,500. And
right of use, what is it?
this is lease asset, right of use asset, lease asset.
34, no problem.
And there is nothing in the property plant equipment.
Non-current asset, property, plant, equipment, right of use asset. So this is actually under your, there's nothing in the property, plant, and equipment. It is right of use asset. And this is actually some kind of property.
IFRS 16 now, sir.
Sorry?
This is IFRS 16.
Yeah, this is IFRS 16. You have right of use asset, probably you lease some property. So you put it here, property, plant, equipment, but it is right of use.
Okay.
65 and 25, this is 4,000. And then you say add back depreciation, which is how much depreciation you had? 1,800. So this much should be your asset. This is what your asset should be, 8,600. Should have been. I'll explain it, don't worry. And then you say actual as per financial statement is 6,500 and lease payments are 86 minus 65. 2,100, these are your lease payments, 2,100. Now, let me explain you. Listen.
Sir, have you done this IFRS 16?
Yes, we did it. We did it. You take something on lease and you put it as a liability, as an obligation, because you have to make payments. At the same time, you create right of use of asset, which means how much asset you own. And these are two different years. If I take in 2001, my liability was 2,800. This 2,800 actually is coming as 2,000 plus 800. These two amounts, 2,000 and 800. So this is my liability. Then when I come to the next year, my right of use asset increased. Right of use asset is increasing. Increasing means that I'm getting some more equipment, some more property on lease, right? Because I'm increasing my asset under lease. So it means that I purchased or got some more asset under lease. So how much asset did you get under the lease? This is the difference between these two numbers, which is 4,000. So this you also have to pay. This will also become your liability because when you are getting asset under the lease, that is your liability. So 2,800 was my liability from the previous year. And then I get some more equipment on lease. And of course I have to pay for that. That is also my liability. So that is 4,000. But then I say add back depreciation. What does that mean? It says that during the year to 31st March 2001, depreciation charged on lease plant was 1.8 million. Like you are showing it, depreciation on this lease plant, this 6.50, actually was not 6.50. It could have been 7.3 something or 8.3 because you depreciated it. And after depreciation, it is 6.5. If there had been no depreciation, this would have been a bigger number. So actually what I got, the plant, I got much more value. I just did not get 4,000. Actually, the plant which I got, the asset which I got is 5,800. I got 5,800 worth of new asset. Do you understand my point?
Yes, sir.
Like 2,800 was my previous year liability. If I do not purchase anything new, the liability would not increase. But then what happened? That I purchased some new asset under lease. And this asset which I'm getting under lease, on one hand, it is my asset. On the other hand, it is my liability. When I purchase an asset of $100,000, so this $100,000 is my asset and this $100,000 is my liability at the same time. So I am increasing the leased asset. So it means that I'm increasing the lease liability as well. So how much I'm increasing?
But depreciation 1,800 is on total lease liability, not on 4,000.
No, does not make any difference. Does not make any difference. I just have to add it. Whether it is on this 4,000 or total, the thing is that if I had not depreciated, it would have been a bigger number. It would have been 8,300.
Yeah, so I'm just saying that the asset I have purchased is not exactly 5,800.
Probably more, probably less. But we can assume that for the sake of simplicity, we can assume that it was 5,800. We charge depreciation. After depreciation, it remained like this.
Yeah.
So you just assume numbers, to let your mind think clearly. So now what you had, you should have been 8,600 should have been your liability.
Yes.
But on financial statements, it only looks like 6,500. 6,500. So it means that you made lease payments of 2,100. This is what you have paid. Otherwise, your liability would have been 8,600.
Yes, sir.
Am I clear?
Yes, sir.
Okay, good. By the way, let me see what we are doing. I will take with you one lesson on Monday as well, same time.
One lesson of which chapter?
We will do practice questions. I'm just picking up some questions. I don't have to do anything else except questions with you guys.
No, from which topic?
You will decide.
How inflation affect accounting? We have not done that. Accounting.
Let's do practice questions for that next. I will explain the topic and we'll do the question on Monday evening.
Which topic, sir?
Inflation effect on accounting effect of inflation.
And this is which standard, sir?
This is your last chapter.
But which standard?
No, it is just like it is interpretation, limitations of financial statement. Let me pick up some question. Okay, cash flow short questions are this much in your book. We may pick up some long question as well, but I want to just to change the taste. I want to do something different with you people.
Sir, we want to do the ratio question also because the ratios interpretation are big, long.
Yeah, definitely we need to do that. No worries, we need to do that.
So daily, if you do 1 hour on questions only, it will be good. Like.
Okay.
So anytime you are free, sir, just give us a message and then we'll join for the short question.
I appreciate that. We need to do a lot of practice. And actually, by the way, you should be doing a lot on your own as well.
Yes, sir.
Okay. Page number 70. Let me open here. Let me stop the recording for a moment. Have you people done some, and I'll start recording. Now, when a typical question like this, it comes, which is final account question, which you call single company financial statement preparation. What they do that usually they give you a trial balance. And of course, after the trial balance, they give you some adjustments. And you need to consider these adjustments. And after making these adjustments and changes, you have to prepare the statement of profit or loss and the statement of financial position. You can see that 8 marks are for P&L and 12 marks are for balance sheet and 20 marks in total. Now, since this question,
basically, I forgot. Yeah, trial balance.
Yeah, this is a trial. Sorry, I didn't understand.
These are trial balance question mainly.
Yeah, this is a trial balance. They give you trial balance and you have to make income statement and balance sheet. So since this question is, typically a long question and data is also a lot, so you have to be careful and selective in your reading. Please do not make your mind, overloaded with a lot of numbers. You do not need to read all of them before. If this question comes to me, I first see that what do they need. So I say, okay, there are 6 adjustments, not a big problem, and they want me to make an income statement and balance sheet. So I'm clear what I need to do. 6 adjustments, ISBS. I go back to the question and I say that first thing which I see the dates. So it is external company on 31st March 2024. Now, usually when you see the trial balance, they give you the closing balances of all the accounts. And you should see that if there is any suspense account given or not. There is no suspense account given here. Usually suspense account is in the last line. And suspense account means that you made a mistake in the trial balance because of some debit and credit. Suspense account means that some debit credits were wrong and debit credits are not becoming equal. And therefore suspense account is there. And we need to clear the suspense account like we did in question number 224, Fresco company. I think it was Fresco. Now, in this particular case, there is no suspense account. So one, your worry is gone. You should not be worried about suspense. Now, there are some line items which do not have anything written in front of them, like revenue, cost of sale, distribution cost, admin expenses, etc. But usually you should be careful about revenue and cost of sale. These 2 lines usually have some adjustment needed. If you remember the notes which are given 6 notes, probably there is some note which is going to adjust these 2 numbers. So these 2 numbers I will not be taking to IS or BS. We need to see what is the final number. Distribution cost, admin expenses, usually they go straight away to the income statement. Usually there is no adjustment. Like I expect that there is a very big possibility that in my income statement, I will write down distribution cost 33,500, admin expenses 36,800, very big possibility. Yes, if there is some note about that, I will check it at the bottom, but big possibility is that there is no note. Here, if you pay attention, usually they give you notes on, non-current assets, interest, long-term bonds, debentures, equity shares, premiums. These are the things where you need to do calculations. And it says loan note, interest and dividend paid 4 and 5 note. So we have to read note number 4 and 5 for interest expense and, your liability. It is going to be the balance sheet item, liability. Interest is income statement item. We will check it, note 4 and 5. Then note number 2 is about plant and equipment. So how do they show you in financial statements? They show you that you have 20-year property at lease, cost is 100,000, and its accumulated depreciation on lease property is 25,000. So net book value is 75,000. Similarly, you have your plant and equipment 155,000. Its accumulated depreciation is 43. So 155 minus 43,500 will be your net book value. So this is how you should understand. But one thing very important, it says that accumulated depreciation as at 1st April 2003. Trial balance is on 31st March 2004. So it means that in this year, in 2004 year, they did not calculate any depreciation. This depreciation amount, which has been given in the trial balance, it is only until the previous year. The current year, current year depreciation has not been calculated so far. So you need to calculate it. Understand? It's a very typical trap. It's a very typical trap that they give you trial balance on 2004, but they give you that the depreciation, it only is coming back from the previous year. Then they told you that inventory at 31st March. So this is my closing inventory. Most probably it will go into my current assets in the balance sheet. Trade receivables are 63,000. There is no note. So most probably it is going to be my current asset in the balance sheet. Trade payables, balance sheet item, bank. Now, if you pay attention, the bank 5,500, it appears on the credit side. It does not appear on the debit side. When the bank appears on the credit side, it means that it is your liability. It is going to be a bank overdraft as a current liability on the balance sheet. Okay. Then you have equity shares of 25 cents each. And there is some note also about it. We need to check that. So one share face value is 25 cents and you generated 56 million cash out of that. So you should immediately calculate that how much are the number of shares. So 56 million is my share capital, which is like 25 cents each. So it means that the number of shares are 56 million multiplied by divided by 0.25. You divide it with 0.25. So you will get your number of shares. And it means 56 multiplied by 4. So 56 times 2, 112. So actually your issued number of shares are 224 million. Because 56,000 is dollars. You collected $56,000 by selling each share for 25 cents. So it means that you sold 224 million shares to get this much of capital. You have got share premium. You have retained earnings. Now pay attention. These retained earnings are given for the previous year. So this is the opening balance of retained earning, not the closing balance. So I will calculate my income statement and I will calculate my profit and I will add it to this retained earning. Okay. This is last year retained earning plus this year profit. And then 5% convertible loan, 50 million. Convertible loan, 50 million, note number 4 we need to see. And then current tax and deferred tax. So usually the items which they give you in F7 for adjustments are deferred tax, current tax, loan notes, equity, and non-current assets, and probably sometimes some lease equipment. These are the things which they do to work on that. If you have any question, please ask me, or otherwise I will go to the adjustments. I'm just teaching you or telling you how to read or try to understand the question. Do you understand until here? Any question you want to ask, please? If not, I will erase it and I will move forward.
Yes, sir.
Okay. Because these lines, they remain there. So when I go to the next page, they also appear on the next page. So in any case, I have to remove them. Okay. So now let's see the adjustments, and we will see that how these adjustments are going to affect us. So if you allow me, I will take this adjustment on our Excel sheet.
Sir, have you started recording?
Yeah, I don't know if I stopped recording or not. Recording is going on.
So you stopped sometime between.
I don't remember. Maybe I stopped, but it is now it is going on. So I'll just make some. I'll take these adjustments here, and we will see how to calculate or what will be the impact of these adjustments. Okay. So we take these adjustments here, right? Can people see Excel or not?
No, sir.
Okay. So now you should be able to see Excel. You see, this Zoom is so good. Technology is so good. It makes exactly the classroom even better than classroom, because in classroom whiteboard is so far away. Sometimes it is difficult to see the whiteboard.
Yes, sir.
Here you can watch everything on screen. Okay, the following notes are relevant. It says that revenue includes an amount of $20 million for cash sales made through Extol's retail outlets during the year on behalf of Francis. Now, Extol revenue, whatever it was, I think it was 490 million or 390 million. It includes 290 million of revenue. These are the goods which you sold for some of your supplier or some other party called Francis, and it is Extol acting as an agent is entitled to a commission of 10% of the selling price. So this 20 million, 10% is your sales commission. You know. By 31st March 2004, Extol had remitted to Francis 15 million of the 20 million sales and recorded this amount in cost of sales. So what he did, that in revenue, he actually added 20 million, and in cost of sales, he added whatever he paid. He paid 15 million, so he added 15 million in cost of sales, right? Whereas he should not be doing it, because these goods do not belong to him. He is selling the goods on someone's behalf, and he is only entitled to a 10% commission. So on 20 million, he has only 10%, which is 2 million. So whatever was your revenue figure, you should say minus 20 million. You should subtract 20 million from your revenue figure and plus 2 million. Because he before added 20 million. So now I take out that 20 million, that it's not my revenue. For me, it is only 20 million multiplied by 10%. So 2 million you should add. So whatever was your revenue. So you would say that X minus 20, X minus 20 plus 10, whatever is your revenue. And in cost of sales, he should be saying that Y minus 15, because he added this 15 million into cost. So we subtract it again. Do you understand?
Yes, sir.
And because 20 million was collected, 2 million belonged to this Extol company because 10% commission. So 18 million he should return back to Francis. Yes or no? After taking 10% commission from 20 million, 2 million is my commission. Remaining 18 million I should send back to Francis. And how much we have sent back? How much we have given to Francis?
80 million.
No, how much we have already given? 15. 15. So what should we do now? We have a 3 million liability. We have a 3 million of liability. Understand? These were not our goods. These goods belong to someone else. We only sold on his behalf and collected the money. So now we got 20 million cash. Out of 22 million is our commission. So we subtract from this 20 plus 2 million. So we subtract 15 million, and 13 million we take on the balance sheet that this is our liability. We have to pay it to Francis.
So this will be the current liability, right?
Sorry?
This is the current liability.
Yeah, of course it's a current liability. So this adjustment number 1, you will say that you will create a current liability on FS for 3 million. So 3 million liability I create. This was your adjustment number 1. It is done. Then you go to adjustment number 2. It says that plant and equipment is depreciated at 12.5%, 12.5% per annum on the reducing balance basis. All amortization and depreciation of non-current asset is charged to cost of sales. So now I need to do my working number 2 for non-current assets. So we need to see, they say that you have to calculate the depreciation at 12.5% on reducing balance method and take it to the cost of sale. So please allow me to go back and bring that number. Okay, I will bring that trial balance here also. Okay, so we are doing it. So let's bring the trial balance also. So if I'm here, I'll say insert. Today was a very, very, very tough day. Today, because all of my groups are in the same position, everybody is ending. I've been teaching, it's almost like 9 hours without a break, just a break of 10 minutes, 15 minutes, and that's all. Anyways, this is last group.
I also saw this group 11. This group 11 is F3 group or F7 group?
No, this is F7. All groups are different.
No, the G11 group you are.
Your group is G12. F7, G12.
Yeah, but there is a group 11 also. I'm part of it, and you are taking that class in the morning, I guess.
Yeah, we had some lesson, not in the morning, we had lesson in the afternoon today.
Afternoon, yes. Suleiman.
Yeah, Suleiman.
So can we join that group also if there are questions you are doing in that group?
You should be doing it actually, because that group is usually we are doing it in Urdu language. And very honestly, that group is like, because these are students, they are not working professionals. None of them is working, and they are crazy. They do so many questions, so much practice, and they bother me a lot. And they drag me into a lesson like 4 times in a week. When students are pushing, teachers cannot say no. So they are demanding. You cannot say that I can only teach you. Sir, can you come for 20 minutes? Can you come for 1 hour? And they keep on writing me. Sometimes they send me a voice message on WhatsApp on personal account. So they are crazy. They are young boys. They have a lot of time. You people are working professionals. You cannot. But if you can join them, it would be good.
But you're saying you're taking it in Urdu.
यार ऐसे ही ना जो हम बोलते हैं जिसको आप हिंदू कहते हैं उसको उर्दू कहते हैं।
अच्छा अच्छा
अब ये समझ नहीं आएगी।
नहीं आएगी
तो अभी अगर आमिर खान को समझ लोगे, शाहरुख खान को समझ लोगे, तो मुझे भी समझ लोगे।
ओके सर
Urdu is not anything different. Urdu is the same thing which in Pakistan we call Urdu, in India we call it Hindi. Like not very Sanskrit Hindi, but normally it is like same language which is used. You would understand. मेरे ख्याल में अभी अगर मैं देखो अगर मैंने कुछ बोला तो आपको ये समझ रहे हो ना मुझे?
हाँ।
बस इतना ही है, यही है।
Okay, I'm lost.
You know that is
You can
the
go, I just
disadvantage
relax.
of not knowing.
Can you do it in Arabic language?
Arabic. You are from Qatar, I know. Unfortunately, I do not. I wish.
Okay, okay.
No, but I teach in
I
Turkish.
don't-
I teach in Turkish language. I teach in Azerbaijani language. I speak Urdu, Azerbaijani language, Turkish, and then English. 4 languages I teach.
That's too much.
Yeah, that's how it works. Okay, so my I can send you some lectures in Turkish language if you want. They're on the demo folders. Okay, so you've got plant and equipment 155. Sorry, 100. So what we need to do, we need to see that what is our plant and equipment. Okay, let me write down here plant and equipment. And this is your cost. Here you've got here. Oh, sorry, this is property. And this is your plant. Your property cost is 100,000 and plant cost is 155,500. You have accumulated depreciation beginning of year. Okay, beginning of year. Beginning of year, you can write down, or you can write down it like accumulated depreciation on 31st of March 2003. Like it says 1st April 2003, which is day 1. I'm taking it last day of the last year. And this is 25,000. And this is minus 43,500. So you've got a carrying value this much. So this is your net book value at 01/04/2003. If you pay attention, I just changed one day. This is last day of the previous year. This is first day of this current year. And then I will say depreciation for the current year. And how much is that? They told you that you have to do it at reducing balance 12.5%. 12.5% reducing balance. So this is my balance. I'll take this one multiplied by 12.5% into -1. And then I say this much multiplied by 12.5% into -1. And I make like this. And then what will happen that this is your, closing, okay, not closing, net book value at 31st March 2004. So this amount will go to your balance sheet. This one will go to the balance sheet, okay? This I will write down in my balance sheet. This I will write down in my income statement. And income statement, you will write down into cost of sale. So whatever cost of sale is given in this question, they told you the cost of sale is 290,600. You will add up these two numbers into it, okay? This will go here. And
Sorry, how did you get 39,375? I missed the calculation.
okay, let me show you. So this is, I did it. If you see the formula bar,
Okay.
I took 75,000 into 12.5%.
Okay.
Because they gave us in question in these notes, they told you that plant and equipment depreciation is done at 12.5%.
Okay.
And it is done at the reducing balance basis. So we calculated the reducing balance thing. Now let me shift it here. From here, I'll transfer it up so that our working was here. Okay. So we put it here. This is. So the sum total of these two numbers, this number actually, this 23,675, I will add it into my cost of sales. And these numbers will go to the balance sheet. And that's all. In income statement, you will take number, and in balance sheet, you will take number. Are we clear on this working?
Yes, sir.
Okay. Then we do another working, which is your working number 3. Because the best way is that you do all of the notes. You say it is note number 2. So that you know that you are not missing anything. So first note was for revenue, second note for non-current asset, third note is that on 1st of August 2003, Extol made a fully subscribed right issue. Fully subscribed means that whatever you issued, all of them were sold of equity share capital based on 2 new shares at 60 cents each for every 5 shares held. So for every 5 existing shares, you are giving 2 shares for 60 cents. The issue has been fully recorded. The issue has been fully recorded in the trial balance, which means that whatever cash you receive in respect of share capital and share premium, because you receive premium here as well. You receive premium here as well because your share price was, if I'm not mistaken, if I go down, one share price was 25 cents and you are selling it for 60 cents. So you receive some premium. You said debit cash, credit share capital, credit share premium, which I just explained to you earlier. But the very interesting thing is that they tell you that it has been fully recorded in the trial balance figures, which means that the trial balance, this share capital and share premium, it includes these amounts. It includes these amounts. So if it includes these amounts, so far, we do not need to make any adjustment here. We don't need this information so far. We may need it in some next adjustment. But if they told me that it is not recorded, then I would calculate, okay, how much did we receive and where should we write it? Because sometimes they will tell you that the issue has not been recorded. It says it has been. Maybe they say that it has not been recorded. If it has not been recorded, then you will calculate how much did you receive in respect of capital or in premium, and you are going to add to these numbers. You are going to add into them. But here they say that it has been recorded. So some part is solved. Life looks easy. Number 4. On 1st April 2003, Extol issued 5% $50 million convertible loan at par. Now it is coming your IFRS 9 financial instrument. 50 million bond, it is convertible bond. Interest is payable annually in arrears on 31st March each year. Always pay attention. When are you purchasing it or issuing it? You are issuing it on the first day of the year. So it means that again, you have to calculate the interest expense for the full year, not for 6 months. So when it is in the beginning of the year, calculation is generally simple and easy. So it's also helping us. So 31st March each year, the loan note is redeemable at par or convertible into equity shares at the option of the loan note holder on 31st March. The interest on an equivalent loan note without the conversion right would have been 8%. So 8% is without the conversion right, 5% we are giving. We are giving less interest. I remember that Ankit made this comment in the very beginning when we discussed IFRS 9 that on convertible bonds, you give less interest rate because you are giving conversion rights. Right, Ankit?
Yes, sir.
So this is the same thing. That market is giving 8%.
Convertible bond only.
Yeah, market rates are 8%. We are giving 5% because it is convertible bond. The present value of $1 receivable at the end of the year based on discount rate is 5%, 8% are these ones. Okay. What we need to do in this case? We need to calculate our liability and we need to calculate our interest expense. Okay. And we need to calculate our liability and equity.
That is like what you are paying, right?
Sorry?
The interest expense is coupon expense. You are paying
5% is my interest expense, 5%.
coupon payment. This is
Yeah,
coupon
coupon rate. It's a coupon rate interest expense there. So you have liability or equity, you need to calculate an interest expense. Okay. So let's please pay attention. We did it many times before, but we'll need to do it carefully. So what happens that you received cash 50 million. Okay. This is what you received. But your liability, it consists of two things. Your liability consists of interest payments, which you will pay for the next years, and the principal return. You have to return back the principal. And how many interest payments you have to make? 3. Because it says that 1st April 2003 and redeemable on 31st March 2006. So 2004, 2005, and 2006. So it is about 3 years. So how much you are going to give? You are going to give 50 million multiplied by 5%, right?
50 million. Okay.
50 million is the value. I'm just always taking 3 zeros on the top. Okay.
Yeah.
So 50 million I would write down like this. 50 million into 5%, you have to pay interest. So how much that makes? Sorry.
2,500. Right? 5% of 50 million.
So it gives you 2,500. Okay. Let me make some columns here. How would I make a column? Okay, I just think I need to do like this. And I will put here 50 million into 5%. And here I will do like this. Here, this is I need to pay. So this is my interest amount. And here is my discount factor. Because I need to find out the discount factor. So this is I need to pay, 2.5 million, 2.5 million, 2.5 million for the next 3 years. So I need now 2.5 million annuity factor. How much is the annuity factor of 2.5 million? Very simple. When you calculate annuity factors, you need to add 3 years. And we will be taking this 8%. Always remember. 5% we only use for the calculation of the amount. 5% is used for calculating the amount of dollars, quantity of dollars, number of dollars. I need to pay $2.5 million. 2.5 million I have to pay, but your discount factor is always the market rate, 8%. So at 8%, your discount factor is actually 0.93 plus 0.86 plus 0.79. So your 3-year annuity factor, my annuity factor is 2.58. Understood?
Yes, sir.
So it means that its present value, the present value of this liability is actually this multiplied by this, 6450. And then I have to return back the principal, which is 50 million after 3 years. And what is the discount factor after 3 years? Which one we should take? 8%. Always discounting, compounding will be done at 8%. 5%, this is the coupon rate. This is the interest rate. We only calculate how many dollars we have to give. But when you do compounding discounting, you do with the market rate. So now this you make. So it means that you have 45,950. This is your present value of bond liability. Are we clear?
Sir, can we just do a quick revision on this? So we have taken discount factor for all 3 years, which is 2.58 to calculate the present value of coupon for 3 years, right?
Yeah, you can do it. If you want, you can even do it without. You can do it like this: 2,500, 2,500. Here the discount factor was 0.93. Here it was 0.86. Here it was 0.79. You can discount them one by one. I took 3 years factor, and when you make a total, the number will become the same. The number is same. Either you do them separately, like year 1, year 2, year 3, year 1 factor, year 2 factor, year 3 factor, and you get 6450. Or because this is a fixed amount for a fixed period of time, you call it annuity. So instead of multiplying it 3 times, you just make a total of these 3 discount factors, and you call it an annuity factor, and you just simply multiply 1 time, and you get the same number.
Yeah. And what are we doing in the second one? So we are also
and at the end of 3 years, you must return back 50 million. Yes or no?
Yes, sir.
So after 3 years, the factor for 3 years is 0.79. So I find out the present value of this 50 million, because this is a 50 million which will be paid back after 3 years. What is the present value of today? So it means that I received this 50 million cash. So I would say debit cash 50 million. Now I have some liability. Yeah. What is my present value of liability? What I'm going to return back? Liability is 45,950, the present value. So all the 3 interest payments and the principal together make it 45,950. So the difference between these two, that is called equity. It goes to my equity. This is my benefit. Okay. As an investor, you are receiving 2.5 million every year. You get interest income 2.5 million every year. What is fun for me? Why I am doing it? I mean, I don't issue bond just to give you benefit. I also get some benefit. So my benefit is this 4 million. And this equity, it will go into your balance sheet as other component of equity. Okay, are we clear on that?
Yes, sir.
So this is your first part. Whenever you are given a convertible bond, the first thing which you need to calculate, you have to split between the equity and liability. That how much is equity, how much is liability. And it is very simple. You have to make interest payments, find out the present value of interest payment. Be careful to use the effective interest rate, the market interest rate, and not the coupon rate. Coupon rate is not used for compounding discounting. Coupon rate we only use to calculate 2.5 million, like say 50 million into 5%. So this is the number of dollars we calculate by 5%. Compounding discounting is done at 8%. So present value of interest payment, present value of principal payment, total present value of liability. This is the cash receipt. The difference between these two is my equity. It goes into my balance sheet under other equity. Then I have to calculate my interest expense. How much interest cost for the year? So now you have to calculate, you have to make your amortized cost schedule. If you remember that financial assets or financial liabilities, so this is something which will be held until the maturity, and it has SPPI, solely payments of principal and interest thing. So you have to calculate its amortized cost. And how do you do that? Now these columns are very wide. Actually, I need some thin columns. Please allow me to do it here. I will say that your opening balance, how much liability do you have in year 1? So year 1, year 2, year 3 you can make, but luckily you don't need to make year 2 and 3 because you just issued it on 1st April 2003 and you are making on 31st March 2004. So you just need to make 1 year calculation. Your opening liability is 45,950. You 8% you accrue, which means that this multiplied by 8%. This is what I should pay, but I am paying 2,500, and then you make a total. This is going to be 47,126. This is your closing liability. This 47,126 is your closing liability at amortized cost. This number 3676, this will go into my income statement as my finance cost. So this is my balance sheet item. This is my closing liability. This is my income statement item. This is my finance cost. Are we clear? It is not very difficult. It is very systematic, very logical. Every time when you get this in exam, 100 times it will be done in the same way. There will never be any different method of doing it. So it may look to you a little bit longer, but when you do it yourself, it would be very quick, very simple, very easy.
So can you please move a little left? I want to read out the adjustments again.
This was adjustment number 4.
Yeah. And why we are calculating the amortized cost schedule?
Yeah, because we have to show our closing liability. How much is the liability at the end of the year, and how much is the interest expense in the income statement?
Okay.
Interest expense will not be 2,500. You are paying him 2,500. Your actual interest expense will be 3,676.
Okay.
This is what you paid, but this is what is your expense actually.
So where we are putting the difference of these two?
Where?
So the difference of these two
will be added here. It is added, and that is why it will become 5 million. That is why it will become 5 million. Like in year 2, you will have this number as opening liability, and here you will calculate your interest, and you will pay 2,500, and this will be your closing liability. Then in year 3, you will take this as opening. You will make your interest expense like 8%. You will pay out 2,500, and on the balance sheet, you will have a liability of 50 million. This is 50 million. There is some rounding difference. Okay. And you will settle your liability. And these are your interest expenses in 3 years. And this is how you will settle your liabilities. It will become 49,768. It will become 50 million. But they do not ask us to do for year number 2 and 3. So I just remove it. That is why that's how you increase your liability, because you accrue interest more, but you pay less, and therefore your liability is increasing. Again, interest is more, you pay less, liability is increasing. Interest is more, you pay less, and you reach 50 million. 3 year finished, you give out 50 million to shareholders, to the investors. Say thank you very much, goodbye.
Sir, where it has asked to prepare this schedule for 1 year, I just missed the point.
No, he did not say prepare it for 1 year. We are preparing financial statements on 31st March 2004, right?
Yes, the balance.
And you are issuing it on 1st April 2003, so it's just a 1 year thing.
1 full year, yeah.
If we had been preparing on 31st March 2005, I would have needed to prepare it for 2 years. I would prepare it for 2 years. Let's suppose if it were 2005, I would have prepared it for 2 years to get this number. Then this will go to the income, to the balance sheet, and this would have gone to the income statement. But I prepared for this previous year to get this opening balance. I mean, why do I need it? If they ask me make it for 2005, then why do I need to prepare this? I need to prepare the previous year to find out the opening balance. That's why I would have prepared for 2 years. Because without preparing 2003, you cannot prepare 2004. I mean, if they ask you, prepare it for 2005 the next year, so you need only this line. But this line, you cannot prepare without preparing year 1. Do you understand the point?
Yes, sir.
So I would have prepared year 1, but I would have taken numbers from here. The numbers, I would have these ones. Okay. Find it down here. So we have done this. One note was difficult. It was long. We did it. Then comes your next note. Please allow me to drag it down a little bit so that we can read it.
Sir, I'm giving this exam for the first time.
Shouldn't be difficult. You are a working person. You have been using Microsoft Excel. Yes or no?
Yes, sir, definitely.
So just keep these tables like 1 schedule, 2nd, 3rd, and so on. You will adjust it in exam. Okay. Now we do this adjustment. Adjustment number 5. It says that an equity dividend of 4 cents. Now please pay attention. Let's do like this. Give me 3 minutes break. I'll have a smoke and then we'll start. Okay.
Definitely, sir. I'll also go ahead and water and come.
Yeah. 3 minutes break.
Yes, sir. I'm on it. Yes, sir.
So now we do this our next working. This is our note 5. Note 5, we can call it working 6 or working 5. So let's read it. It says that an equity dividend of 4 cents per share was paid on 30th May 2003, and after rights issue, further dividend of 2 cents per share was paid on 30th November 2003. Now, if you remember, they told us in this note, there was a note which was here that on 1st of August, they made some right issue. So it means that some of the dividend, like 4 cents of dividend, was paid before the right issue, and 2 cents of dividend was paid after the right issue. Do you understand the point? We are giving dividend 2 times in a year. One time before issuing the new shares and 1 time after issuing the new shares. Now, if I have to calculate that on 30th November, how much shares you had? How much shares you had on 30th November? If you see this as here, 56 million is your capital, right? So on 30th November, like by the end of the year, you had actually 30th November, let me write down like this, number of shares on 30th November. I know that it was like 56 million divided by 0.25, okay? So it is like this. And how much it is? It will give you number of shares were, your number of shares were 224, and you are giving dividend 0.2 cent. So it means that the dividend paid is 4480. But then you also gave some dividend. It said that you gave dividend before the right issue, before issuing the new shares. You also gave dividend earlier. You will say that number of shares on 30th of May. On 30th of May. So how many shares? And you paid here dividend 0.04 cents, but you do not know your number of shares. Can you tell me how much were the number of shares on 30th of May? Can we find out the number of shares on 30th of May? Mango? Pamela?
The shares.
Yeah, what were the number of shares before? You see, you had some shares in the beginning of the year. Then in the middle of the year, you issued some new shares, and the total is 224. This 224, it is at the end of the year. In the beginning, how many shares you are giving as right issue? Can you read this statement number 3? Please read note number 3. You are giving, please pay attention, you are giving 2 new shares for every 5 held. So whoever had 5 shares before, he would get 2 shares more, so he would get 7 shares, right? 5 he had, 2 you give more, so the new number of shares becomes 7. So it is 2 shares for every 5 shares. Am I clear?
Yes.
So then what you should do here, that your number of shares here will be 224,000 divided by 7 multiplied by 5. If I do like this, your shares before were 160,000. 224 divided by 7 multiplied by 5. Now, if you want to check if I did it correct or not, so let's see like this. 160 you had, and you said that I'm going to give for every 5 shares, 2 shares. So this is the bonus shares or right share issues I'm giving. It makes like this, and you make a total, and it gives you 224. So that's the same number. So actually, what you should say that after the right issue, the number of shares are 224,000. This you calculate from the balance sheet. Your right issue was 2 for 5. Your right issue was 2 for 5, which means 2 plus 5, 7. So you divide it with 7, multiply it with 5, you get your old number of shares. That before you had 160. So during the year, the first dividend was given when you had only 160,000 shares, 4 cents you gave, and you come here. So total dividend given in the year is this much. Do you understand this thing now? Ankit, Emmanuel, Pamela?
Yes,
Is it clear?
Yes, sir.
Okay. Now, why do we need this number? What are we going to do with it? Can you tell me?
Dividend paid, we need to put it into income statement.
No, dividend paid is not income statement. Dividend paid will be subtracted from retained earning because
Sorry,
that you have your opening retained earning. Now, if you pay attention to the trial balance, please come to the trial balance. You have your retained earning figure, right? How much is the retained earning given? On the credit side, it is always. Yeah, retained earnings are 26, right? And this is at which date? Is it at the end of the year or the beginning of the year?
Beginning of the year.
Beginning of the year. So what I need to do like this. I would say that opening retained earning, how much is that amount? 26,080. I will say add 2004 profit. This is, you will calculate from your income statement, whatever it is X dollar. You will make income statement and you will calculate, and you will say less dividend paid in 2004, which is this number. Okay, and then you will make a total of that, and this you will say closing retained earning. So when you will make your balance sheet, this closing retained earning will change. You will have opening retained earning plus profit for the year minus dividend paid, and you get your number Y. And this number Y will be shown in the balance sheet as your closing retained earning. That's why we need to calculate it. Is it clear?
Yes, sir.
See, I tell you, these things are not very difficult. They look sometimes strange because you are doing them for the first time. But once you do 5-6 questions, then everything is repeated again and again. Okay, this is the last question, the last part. It says that the balance on, so now we say note 6 about taxation. I'll read it with you. The balance on current tax represent the under over provision. Now he is always trying to trick you. He does not tell you whether it is under or it is over. It says under over provision. So you have to see it yourself. If it is under provision, it means that last year you allocated less amount, so you have to pay this year more tax. If it is over provision, it means last year you allocated more amount, so this year you will pay less tax. So under provision will increase your tax expense in this year because last year you under provided. Last year you paid less, so you have to pay now. Over provision means that you paid more last year, so this year you will pay less. So it says the balance on current tax represent under over provision, and you have to find it yourself that whether it is under or over, and I will show you how to do it. Provision for the tax liability for the year ended 31st March 2003. A provision of 28 million is required for current tax, and the deferred tax liability were assessed at 8.3 million. This is a little bit cut. It's not clear, but I tell you that they say that deferred tax liability is needed to be 8.3 million. Okay, so we need to make our tax expense. Now that is, we need to go back to our trial balance and we say that how much is the tax, which is shown here. How much is the tax? What do you see for the tax? Current tax is how much? 32. Now please remember, if it appears on the debit side, it is always under provision. I will write it here because when you see it, you remember it. If it is on the debit side, it means it is an under provision. It means that last year we recorded less, and therefore we are writing tax expense. So if it is on the debit side, it means that it is expense, and if it is expense, it means that last year we paid less. That's why we are recording an expense. So this is an example of under provision. So I would say that under provided in last year. So we have to pay 3,200 more in respect of last year. So this 3,200 is actually I have to pay in respect of previous year, because previous year I paid 3.2 million less. Add current year tax provision. So how much is your estimate for current year tax? So current year tax, they told us here, it is 28 million. So this is what I need to pay. 32 from the last year, 2,800 from this year. Plus I need to make adjustment for deferred tax. Adjustment for deferred tax if you have to make. So how much is deferred tax on the balance sheet? On the balance sheet, on the trial balance, deferred tax is 4.6 million.
Sir, what is the current year tax provision? 28 million.
28 million.
Okay, one more zero then.
No.
This is 2.4.
Sorry. So this is also 3 zeros. Wait a minute. 32, 3.
No, this is 28.
Okay, right, like this. And then you have 4.6 million from the previous year. You already have it on your deferred tax. But how much do you need? You need 8.3 million, right? So 8,300 you need, and how much it was? 46 you already have. So 46 you already have. So you need to increase your tax liability. Deferred tax liability will also be increased also. So this is here. So when you make it total, that is your tax expense.
So, sir, why do we create a deferred tax liability?
Because there were some revaluations, your probably temporary differences are more, deferred tax, your asset valuation has become more, so you need to pay more tax.
So there should be some estimate or value for these deferred tax.
Yes, they did not give you. In some questions they asked you to calculate. In this question they are very kind to you. They said that it is 8. So what you had before and what the difference is there. And you know that when you will make a balance sheet, this 4.6 will not be there. This time in the balance sheet, instead of 4.6, you will write down 8.3. And the difference here, and this is your current liability. This will become your current liability. And this will become non-current liability. This will be current. Okay. Now, these are the only adjustments. Now, what I would suggest you people, now I actually explained you all the question and I did all the workings. Now we need to, put things up together in financial statements, but that I leave the task to you. You have your book. Please go and start making your ISBS based on these adjustments. I will be uploading this thing probably tomorrow or today or tonight, maybe tonight or tomorrow. If you want, you can take screenshots for doing calculations. I mean, if you want to continue the question, you can make these screenshots. You can see that, okay, whatever it is. Because don't wait for me.
Can you first, sir, yeah, this sheet is already with you, right? Just save and send it over email.
Oh, yes, that is easy. Wait a minute, that's a good idea. Because uploading takes time. It's 2311. So, okay, what we did that first, you will see in the sheet on the top the cash flow questions, and these things you will see at the bottom. Now, let me say like this. Don't go. Please stay. Otherwise, I will forget. I will send it now. Okay?
Sir, I'm writing down my Gmail ID. You just save and send it to this.
This is what I'm saying. That please write down your Gmails. So
What should we write off?
I mean, write down your email address so that